Right. That's one of the reasons I named my book Make It, Keep It, because keeping it, is part of the game, right? So you
Hmm.
made a lot of money, you're about to give 40, 50% to the.
Hey everybody, welcome back to another episode of the Richer Geek podcast. Today we have Dr. Amir Baluch. He's a semi-retired anesthesiologist and best-selling author of the book Make It, Keep It. After spending half a decade working at a boutique investment bank with his securities license, he ventured on his own to create an alternative investment platform, Baluch Capital, to help high-income earners achieve better work-life balance and passive income and diversity. That's what we all love. That's what we hit on just about every episode. How are you doing, Doctor?
Doing pretty good. How's it going out there?
Well, doing great. We'll see. We'll talk a little bit about what you're seeing in the economy and interest rates and your plans. But welcome to the podcast and give everybody a little bit of background on who you are.
Well, so my name's Amir Baluch, and like you were mentioning, I'm a semi-retired anesthesiologist, and now I'm basically full-time wealth strategist and fund manager. And of course, it didn't start like this. Every story like this has its roots,
Mm.
but I kind of got into this position by necessity. So, but that's pretty much what I'm doing now. And if you want to hear the whole story chronologically, I could do that for you to give a background. Maybe some people can relate to
Yeah, well, you can
it.
give us a little taste of what it is because a lot of times, if people want to invest with you as a GP, they want to know, you know, who this guy is, and am I going to like him? So give us just a hint,
Right.
and then where you went from like investment banking to all of a sudden having your own funds and
Got
syndications.
it. Well, so in the year 2000, almost, I guess that's a quarter of a century ago,
Yeah.
I applied to medical school, but I didn't get in. And so that was a big blow to me. And then I figured, okay, well, I've succeeded in all these other things. Let me start my own business.
Hmm.
And I failed at that too, lost my life savings in the electronic
Yeah.
payments business.
Yeah.
So then I said, okay, let me regroup. I'll reapply. Let me move back in with my parents in
Yeah.
Midland, Texas. And then my dad, who's an internal medicine doctor, actually went
Mm.
bankrupt a few months later. We had to move to a one-bedroom apartment, $250 a month with, sometimes we have hot water, sometimes we didn't. We just kind of rebooted everything. And then as I was staring at the ceiling fan, I was thinking, you know what? I don't want this to happen again or to anybody else that I know. Um, so what do I need to do? So I figured let me just learn a lot about personal finance and investments
Hmm.
and get that going. So after going through about three or four hundred, I mean yeah, about 300 books, a lot of them in audio format.
Hmm.
I got into real estate. Eventually, I did get into medical school, but I continued with real estate initially because there's some statistics saying, hey, the first million that people make is in real estate.
Hmm.
Now, of course, I didn't get anything going when I was 21, 22, but I didn't have mentors or credit or money
That's right.
either. You
Yeah.
kind of need something, right? You need something to get started.
You got
But
to have something.
right. But eventually in '05, when I was in medical school, I was an LP in a multifamily deal with a private REIT in San Antonio. And then after that in '08, I was a resident in Miami doing anesthesia. And I did my first short sale flip while in Dallas, even though I was living in Miami. Then in 2010, I came to Dallas to start anesthesia. And in 2011, I got my securities license and joined a boutique investment bank because that's what I do. I like to learn, right? So I figure, how am I going to learn about investments? Let me go to where they have the biggest investments and see how to do it right. And after about half a decade with them, we went through a little bit under $1 billion worth of transactions, a lot of it in in multifamily hard money lending and things like that.
Hmm.
Then I went off on my own around 2015, 2016. I pulled my brother out of his MBA courses. We started Baluch Brothers Development and Baluch Capital where we build subdivisions in Dallas.
Hmm.
And we brought on a couple of our physician partners that really wanted to partner up with me. So we made our deals bigger, and that's kind of how we got to where we are now. And then I continue to read. I never think I know everything, right? There's always something to learn. So as I was learning more and going to conferences and learning from the best fund managers in the world, I learned about correlation ratios and the importance of diversity, which is why we also started a few private equity funds investing in life sciences and biotech. And then we also had some fixed income funds at 12 and 18% preferred returns for the cash flow aspect that was non-correlated to real estate and things like that. And now we have our first fund in the public markets, but trading in the Indian stock market, which has 4 times the GDP of the US, if you can believe that. And so I'm always on the lookout for what is the next asset class that's not correlated to what I'm doing to give some people some true diversity. And that's what we do right now. It's basically a full-time job.
Yeah, well, it sounds like it. I mean, I can't imagine. It's so, talk us through. People go to your website. It's baluchcapital.com, everybody. And we're talking to Dr. Amir. Um, they go on, there's some educational, you can schedule a call, and then talk to us about the different types of things that you have, the cash flow, the vested type of deals. Um, and then what is the advantages of being an LP? Instead
Got
of
it.
like
Got
going, hey, you know what? I'm just going to stick it in Apple stock, or I'm just going to stick it in,
it.
in whatever. Um, what are some of
Well,
the
there's a lot of
benefits of
couple
being?
things, and so this is a really good point because a lot of people don't talk about this. But
Mhm.
so first, we're talking about different asset classes, right? Why doesn't somebody just stick with S&P index and call it a day? I'll tell you the quick answer, and then I'm going to explain kind of different asset classes, how they're similar and how they're different. So why you shouldn't stick with one is if you look at Goldman Sachs and JP Morgan's data, because we've had this crazy bull run in the
Mhm.
stock market, they're predicting, and nobody has a crystal ball, but some pretty smart people are predicting that the S&P index will probably only average around 3% a year over the next 10 years because we've been tracking around 13% over the last 10 or 12 years, right? So you don't want to be stuck in something like that. And now if you do plan on retiring one day, you just push that back by a decade or more. Now everything has a couple things in common. What does the stock market have in common with everything else? Pretty much every deal, every investment has risk, has a return profile, and has a liquidity profile in its simplest form. So if I say, hey, here's the return and here's the liquidity, oh, it's a 2 year note, 5 year note. Hey, we plan on flipping this thing in 6 years, whatever it is, then that's pretty easy to understand, but it's not easy to understand risk.
Mhm.
It's very hard to underwrite that and to turn it into a number because there's other things that have numbers. So when you diversify into private equity, different subsets of real estate, their risk profile is different. Some are interest rate sensitive and cap rate sensitive. Some are geographically sensitive. Some are arbitrage plays and have nothing to do with interest rate. And it doesn't matter who the president is tomorrow. And so when you diversify enough, and if you read Ray Dalio's book called Principles, if you diversify across 8 or more asset classes that don't have correlation ratio or not highly correlated with each other, mathematically you reduce your risk by 80%, but you're still getting the same or sometimes even higher return. So if you decrease your risk by 80%,
Wow.
your reward to risk ratio is 5 times what the average person is. It's way easier to reduce risk than it is to squeeze out an extra 1 or 2% out of an asset class, right? So that's the reason for diversifying. So you're asking that was the main question you're asking, why
Mhm.
not just go in S&P? That's the reason. It's probably one of the most riskiest things you could do with your money is go all in on one asset class and
Mhm.
and hope and pray that it'll be okay.
Yeah. And some of the tax benefits of, we know real estate, the depreciations and things like that, um, and what I love, not a lot of the stock market, ladies and gentlemen, what can you do on your, we call them K1s, on your end reports. You can get a dividend, you can get money, you get appreciation more, it's more stable, and you actually get to save on your taxes. It's like
Right.
name a stock, name another type of asset class other than some of the things that we're dealing with. Just the benefits of being an LP. It's when we start a first year, in a syndication, the investors, and especially ones like in California, they're like going, "Oh my God, thank God, these accelerated depreciations and things like that," because their taxes are so high. And
Right.
uh, people don't realize that they can also see that, they're thinking about cash flow. I'm just throwing my money in and it's going to appreciate, and they're going to sell, I'm going to make money. But they
Right.
don't
Right.
understand all the other different types of things that is also a benefit of being a limited partner.
Right. That's one of the reasons I named my book Make It, Keep It, because keeping it, is part of the game, right? So you
Hmm.
made a lot of money, you're about to give 40, 50% to the IRS, and who knows what the government's going to do with it, maybe not, use it appropriately. You might as well try to keep that for yourself. So it does make a lot of sense from the depreciation point of view for sure. Or any even different asset classes, private equity has rule IRC 1202. I don't know if you heard of that, but if you buy into private company shares and the value is under 40 million, if you hold it for more than 5 years before you get any payments, there's no capital gains. It's basically
Oh,
tax free.
wow.
And so there's all these different benefits in all these private asset classes. You just have to see what it is. Or like we are building real estate in opportunity zones right now.
Hmm.
If you hold that for 10 years, there's no capital gains. Or if you bought a rental in our Fort Worth subdivision that we built, we've negotiated down the property tax to $200 a year as a tax abatement, plus $2,000 tax credit per house. They just want this area revitalized, so we're revitalizing it, and the government is financially incentivizing with some tax breaks.
Wow. And might as well take advantage of it. And I tried not to smile when you said, that Washington may misuse our tax dollars in this. just
Right.
just maybe, just maybe. So let's talk about the funds that you have currently going on, and then we'll talk a little bit about your book. Um, you have some current funds that are going on. I don't know, the pre-IPO one, like maybe healthcare, another private equity.
Right.
Talk about.
I'd say, oh, go ahead.
No, well, I'm just saying, our listeners are going to hit on your website and they're going to go, well, okay, I see average analyzed returns, growth, but I have no idea what
Yeah.
exclusive pre-IPO private company. I don't explain some of the things that
Right,
you're doing.
right. Well, so what I'll do is first I'm going to step back and break alternative assets into three categories, or else it's going to look like a laundry list. So
Yeah.
in the alternative asset space, I think of three things. There's real estate, then there's private equity, which just means private businesses, and there's a lot of them. And then there's private credit, which could be a debt or a fixed income product. So under real estate, what do we have in real estate? We basically have doubled down on build to rent communities, which we feel is basically multifamily 2.0, but without the interest rate sensitivity and without the ceiling on rent growth. And it's also only 5% of the rental market right now. And all the data is showing that we won't even come close to meeting the housing supply demand for about 15 years at the current rate that we're building. So we really like that, where people can make money on the development side with promissory notes. They could be a LP. Some people want a JV if they put in more
Mhm.
than 1 million. We have some joint venture opportunities. So that's for the most part what we do in real estate, although my background is multifamily, but that's what we've been doing for like probably the last 8 years, 10 years or so. Now, also if somebody wants to buy one of these properties and just have it as a rental, or since we write the HOA, we usually have these all approved for Airbnb. So there's some tax
There you
benefits
go.
too if your significant other wants to get rep status, real estate professional status, and manage it. Now, crazy tax
Hmm.
benefits you're going to get. I'm sure you've had a podcast on that at some point. If
Yep.
not,
Yep.
we should do one. So that's another option. So those basically are two real estate plays. You can come in as a debt partner, you come in as a limited partner, or you come in as a joint venture if you bring a group of people and knock out a whole deal with, 2 to 5 people. Now, in the private equity, that's basically private businesses. And a lot of things we do, we actually don't put on the website. It's just, we'll build them for certain people and the thing closes before I could even market it.
Yeah.
So, for example, we've bought out individual e-commerce companies and doubled their value and then sold them through brokers. And so then you get some cash flow, and then you get an equity multiple that usually doesn't take 5 years. And usually in about 2 years, we could be in and out of these things. You could, potentially double your money or come close. For most of private equity, when people think private equity, you got to break it down into 3 categories. So start off with 3 categories, right? And then
Hmm.
private equity was one of them. Now, private equity, let's break it down into threes because threes are easy to remember, right? You have venture capital, which is the idea stage. Then you have growth equity, which is like your series A, B, C,
Hmm.
whatever, where now they've got traction. They're not just an idea, they're actually got some revenue and they're growing. And then when they're a stabilized company, if you want to get into a stabilized company, that's the leverage buyout space where, big private equity companies are rolling up, chains of companies, right? And making them even bigger and then pass it on to the next guy that wants to do the same thing. So in my private equity world, for the most part, we're on the edge of venture capital and growth equity. So yeah, they're a little bit past the idea stage and they're about to get on the inflection point of growth. We like to be there.
Hmm.
And on the other side, when it comes to e-commerce, we like to buy existing stabilized stores that maybe haven't expanded to other channels or maybe haven't gone to brick and mortar. And then
Hmm.
we do that as the value add. So for the most part in private equity, I stay in those two zones that I understand, which is e-commerce and then specifically life sciences,
Hmm.
biotech type stuff in private equity. And so we have those open. Right now, we actually don't have any of those open. All three of the funds are closed, but will be reopening it up uh, next quarter where we have some deals where we could be partnering with an ex-CEO of Google and some other ones. I can't mention their names on here yet, but some people that pretty much everybody, is household name for some people. So really
Hmm.
cool things, coming down the pipe.
And
Now,
in order to invest with you, a lot of people don't maybe not know the difference between the B's and the C's. Um,
right.
Accreditation or not. Most of your funds are C's.
Most of them are C's. They used to be B's, but now they're pretty much C's. What does that mean? That means I could talk about these things online or on a
Hmm.
podcast. So that's pretty much what the C means. And then also you have to verify that somebody is accredited, or in some cases, in some of our funds, you had to be what's called a qualified client, which means net worth
Yeah.
2.1 million. So those are the two classes of investors that we take. And sometimes if you do a 506B, the securities gets really complicated.
Yeah.
One of the reasons I went and got my securities license. But in a 506B, where you can't advertise, in some cases you could take a certain number of non-accredited investors,
Yeah.
right? And we have thought about doing a regulation CF, which is a crowdfunding, or regulation A. And
Hmm.
those funds you could take anybody, but we haven't done that yet because it costs a lot more money to do that. And
Yep.
then most of the people that are working with me meet the accreditation, requirements already.
Yeah. It's and we don't need as GPs, we don't need someone begging us, hey, I need my $5,000 back because I can't
Right,
pay my
right.
house payment. You don't want even want the deal. Yeah.
Right, right. It's a big headache. And
To
imagine
pay.
every one of these investors, you have to still have a certain amount of bookkeeping fee costs. Like there's
Yeah.
some fixed cost to handle every investor. So if the return is 10% on 5 grand, right? Like $500, but the K1 costs 150 to prepare it. Like it's not looking that good when a third of your investment is gone to the CPA fee, right? So
That's right. That's right. So, um, and yeah, because a lot of people will say that it's like, I want to invest with you, but I'm not accredited. Why don't you ever do B's? And I'm like, because I'm too busy to do a
right.
P to do a B. And it's people just a lot of people just don't get it. But so let's talk about your
Another
book.
alternative,
Yeah, go
another
ahead.
alternative, let's say somebody is almost an accredited investor, right?
Hmm.
Like maybe their net worth isn't a million, but it's 950K. And maybe
Hmm.
they make 180,000 a year, not 200,000. Well, in some cases, we've put together joint venture things where, maybe it's just a quick $1 million raise and we might just need 5 people coming in. In a joint venture, you don't have to be accredited. So that's more like a partnership structure. So, but you just have to,
Hmm.
I'm not a securities attorney, talk to them about what you're doing first
Yeah.
and get all your ducks in a row. But we've done joint ventures and I still have all my investors are accredited, but I don't have to. I could take somebody that's not accredited in a joint venture, although
Yeah.
we rarely do joint ventures.
Yeah. Yeah. And plus, yeah, the only time I do joint ventures is when someone gives me enough money to warrant it, and they're usually well
Right,
beyond a C. You know.
right, right.
Um, so let's talk about make it, keep it. Um, what
Got it.
made you want to do it? Write the book and what's in it.
Well, while I was working full time in the hospital, a lot of people would just ask me in the doctor's lounge this and that and some basic stuff. Because, as doctors, we don't get any of this education in medical
Hmm.
school or in college or anything, right? And so I was saying the same things over and over. And I figured, hey, why don't I just write a book about it and just give people the book? It's a quick read. It's only like a 2.5 hour read. But if
Mm.
you're starting from scratch, this really lays a decent foundation and you'll probably have more questions afterwards, but you kind of know the lay of the land. It's kind of like a map for investing to an extent. And I wrote the book chronologically where, let's say if you were a physician or anybody that's, gone through some, higher level education, when you first come out, you don't know what to do. You're making money right now. You just finished college or
Hmm.
whatever school you went to. So we talk a lot about the psychology of investing, what the definition of an investment is, what diversification means. And then in the middle of the book, now we have an older avatar, maybe somebody in their 40s or 50s. Hey, now you're making money, you've got the mindset, you're making a plan. Now we talk about different asset classes and how they vary in their risk profiles. Then at the end, now you've accumulated a lot of money, you have a high net worth, you have passive income. At the end, we talk about how to keep it, tax deductions, asset protection, also some philanthropy. How do you give to charity? For
Hmm.
example, I just actually bought a college in Pakistan, 3,000 students, and we're teaching them. Uh, I'm building a curriculum to teach them about AI and freelancing and stuff
Hmm.
like that, so they can make money in other countries and help stabilize their economy is one of the things I wanted to do. So that's kind of like now my philanthropy arm is that. But we talk about how that has tax benefits too if it's done a certain way. So that's more. Now we're talking about more about the keep it side, whereas the
Yeah.
first part of the book is more on the make it side. And that's pretty much it. So it's a 2 hour read, maybe two and a half.
On Amazon.
It's on Amazon. Yep. And I
Very
think
good.
somewhere, we'll have a special link for your viewers where they could get a free copy of this book if they want. They just have to pay the shipping.
Sure. You're sure. Amir, is there anything else before I let you go that I might have missed that you want to talk to, with our listeners?
Well, if the listeners out there are looking to diversify,
Hmm.
one important thing is uh, just understand that diversification doesn't mean, oh, let me get Apple, Tesla, and
Right.
a bunch of things in one asset class. You got to be in asset classes that really are not going up and down in values based on the same variables. And that's where I think a lot of people mess up. um, Either somewhere on my website or one of my webinars on my Instagram, I talk about, Yale and Harvard's endowments and how they've diversified into how they allocate a certain percentage of private equity and real estate and private credit. So you kind of want to get an Excel file and break that down and make a plan.
Mm.
And you don't have to be exactly like these other guys, but find out where you feel comfortable, where your deal flow is. For example, I'm very comfortable with real estate and e-commerce. I'm going to do a lot more there
Yeah.
compared to maybe doing something farmland related or some that I don't know anything about. So my allocation is going to be different based on my expertise and my deal flow. And then for all the listeners out there, it's going to be a little bit different too. And
Yeah.
for sure, try not to do this on your own.
Mm.
I think investing is a team sport. Like the only reason I could
Yeah.
even do any transactions in my 20s is because I partnered up with a bunch of people. I mean, the first few years trying to do it on my own, I pretty much got nowhere. As soon as I started becoming an LP, now actually something was happening. And then I went into a deal, a few years after that where I could do my own deal because I had learned from my mentor. So, starting off as an LP is a great place to go. And if you could be an expert LP,
Hmm.
and really understand how to make a good portfolio, you probably don't actually need to do anything else than that.
Yeah.
So
Yeah.
that could
Why
be
why
almost a
have why
job in
have the
itself.
headaches? Why have the headaches of being the GP if you can just make a living being an LP, right? It's
Right, right.
um
So
but
that's
yeah,
what I would say for my overall best advice for the listeners today.
well, and especially, ladies and gentlemen, you've heard me harp on it over and over again. It is about mentorship. It is about your networking. Never stop learning. Both Amir and I are successful. We still have our mentorships. We still have people that we ask questions. Amir, where can people find you?
Well, LinkedIn is a pretty easy way. It should be maybe the only Amir Baluch on there. That's also a doctor. I should pop up on there with a yellow background. Also, if you contact us through baluchcapital.com, that goes straight to me as well. And we'll have a couple of gifts for your listeners too. If they want to book a one-on-one call with me,
Hmm.
or if they want to get our top 20 tax checklist, because I know once you become a high income earner, you got to protect yourself, right, and keep
Hmm.
what you make. And then also, if somebody wants a free copy of the book, there's going to be a link on there. You just pay for the shipping, and you can get it, probably in a couple of days.
Absolutely wonderful. Amir, thank you so much for coming on the Richer Geek podcast. Have a great 2025. We'll see you later.
Thanks. It was a pleasure. Thanks for having me on.